All right, let's dive into the latest earnings from Church & Dwight. Now, this is a company whose products are probably in your house right now. But the real story here is how they managed to navigate a pretty tough market. So let's break it all down.
So heading into this earnings print, Wall Street was, well, they were pretty nervous. All the chatter was about these big headwinds. We're talking tariffs, slowing consumer demand. The big question was, could Church & Dwight actually pull it off? Or were we about to see them get hit hard?
Well, the market's reaction? It was immediate and it was big. A 7.2% jump in one day. That's a huge move. So what on earth did they report that got investors so fired up? That's exactly what we're here to figure out. Okay, first up, the headline numbers. And honestly, this part's pretty straightforward. It was just a clean beat, top to bottom. Let's look at the specifics. Adjusted earnings per share hit 81 cents. Now, the consensus was around 75 cents, so a really solid beat there. And on revenue, they brought in over $40 million more than expected. In this kind of economy, a clean beat like this is, well, it's exactly what the market wants to see.
But look, as we all know, the headline numbers are one thing. The quality of the beat is what really matters. So how did they do it? For Church & Dwight, the story this quarter, the real story, is all about volume.
And this is the part that really got my attention. Their growth was driven by a 4% increase in volume. Now that is so important. It means they weren't just jacking up prices to make their numbers look good. No, they were actually selling more stuff. That tells you the demand for their products is legitimately strong.
And this wasn't just one lucky division carrying the whole company. The growth was everywhere. Domestic was up, specialty products were up, and international, wow, up a massive 7.7%. This was a case of all engines firing at once. And you know what? That strength flowed right down to the bottom line. Their adjusted gross margin, it blew past their own outlook by 110 basis points. That's a full 1.1%. And they did it by just executing really, really well. Their internal productivity programs were so good, they basically neutralized the hit from inflation and all those tariffs that had everyone so spooked.
And if that wasn't enough, management put their money where their mouth is. They bought back $300 million worth of their own stock. $300 million. That's $600 million for the year so far. You don't do that unless you're incredibly confident about your future cash flows.
Okay, so let's zoom out a bit, because this quarter wasn't just about hitting the numbers. It was really a glimpse into their bigger strategy, a major reshape of the company's entire portfolio.
So what are they doing? First, they're trimming the fat. They're getting out of brands like Flawless, SPINBRUSH, and the WATERPIK showerhead business. The idea is simple. Get rid of the slower-growing parts of the portfolio so you can double down on your winners.
And at the same time they're pruning, they're also planting. Take their new acquisition, Touchland. It's the fastest-growing brand in its category, and the CEO basically said it's doing even better than they'd hoped. That's the strategy right there. Out with the old, in with the high-growth new.
The final piece of this big strategic shuffle is the vitamin business. It's under review right now, and by the end of the year, we're going to get an answer on its future. Are they selling it, partnering up? Who knows? But for anyone watching this stock, that decision is a huge catalyst to keep an eye on.
All right, so that's the quarter and the strategy. But what about the future? Let's get into their updated guidance and what the analysts were asking about on the call. No surprise here, they raised guidance pretty much everywhere. We're talking higher sales, higher EPS, and better margins for the full year. But the number that really stands out is cash from operations. They bumped that up to $1.2 billion. That signals some serious confidence.
The Q&A session was super interesting. It really showed how well-positioned they are. On the one hand, you've got consumers looking for value, and boom, Arm & Hammer Laundry is there to catch them. But at the same time, their premium stuff like THERABREATH and Hero is just crushing it. They're winning at both the high and low end, which is a fantastic place to be. Oh, and they also mentioned that those tariff worries, they've managed to knock that headwind down to just about $25 million. Totally manageable.
Okay, so that's the look back at the quarter. Now for the fun part, our view. What's the call, and what should you be watching for next?
So, here's what we're tracking. Number 1, that big decision on the vitamin business by the end of the year. Number 2, the THERABREATH toothpaste launch in January. That could be a huge new growth driver. 3, just keep an eye on those margins. Can they keep outperforming? And finally, watch the market share numbers in their key categories, laundry and litter. That'll tell us if the volume story has legs.
Look, if you take away just one thing, it should be this. The investment thesis here is shifting.
This is no longer just a story about raising prices to combat inflation. It's evolving into a story about real volume growth, smart portfolio management, and innovation. That's the playbook for 2025 and 2026.
So when you add it all up, the strong volume, the incredible cost control, the smart strategic moves, and this new chapter in their growth story, our rating here is clear: outperform.
Of course, please remember, this is not financial advice. Always do your own homework. Thanks for tuning in.